Today we're going to talk about the nature of costs, which is Module 1 of this course. The topics of this lecture break down as follows: cost classifications and terms, break-even calculations and analysis, operating leverage, and cost behaviors and estimations. We'll go through each one of these with examples. First, we need to talk about a series of terms. In the beginning, these will probably sound very confusing to you, but as we work through this course over the next 7 weeks, these will become second nature. So if you don't at first grasp the understanding of each of them, give it some time, it will come to you. First, we break costs down into manufacturing costs and non-manufacturing costs. Manufacturing costs are the costs that go into making up a product: direct materials, direct labor, and manufacturing overhead. Direct materials are the materials that go into making the product. For example, if we are making a desk, we probably have particle board, formica, casters, things of that nature. That is the direct material. For something to be indirect labor, it has to involve someone laying their hands on the product or operating a machine that makes the product. Everything else is considered to be manufacturing overhead: factory supervision, factory utilities, factory property taxes, things of those nature. Non-manufacturing costs are not related to the product. These are selling, general, and administrative expenses. These do not get inventoried, where manufacturing costs do get inventoried. The acronym for non-manufacturing costs are SG&A. So now let's talk in terms of product costs and period cost. Product cost is synonymous with manufacturing cost. Period costs are synonymous with SG&A. The reason for that is the product cost is inventoried. The period cost is charged off in the period in which it is incurred. Then we have another couple of terms: prime cost and conversion cost. Prime cost consists of direct materials and direct labor. So if in your readings or in your homework problems you run across the reference to prime costs, they are talking about direct material and direct labor. Contrast that with conversion cost. Conversion costs are direct labor and manufacturing overhead. So what happens is we take raw material and we convert it to a finished product by applying direct labor and manufacturing overhead to it. If you refer back to slide number 5, you will notice that direct labor is a prime cost and is also a conversion cost. Now we can use another term: manufacturing costs in terms of direct. So when you see they say it's a direct manufacturing cost, they're referring to direct labor and direct material. An indirect manufacturing cost is manufacturing overhead. Now let's talk for a moment about how costs behave. We break them down into 3 categories: fixed costs, variable cost, and mixed cost. A mixed cost is a cost that has both a fixed and variable component to it. And we'll deal with that in some more elaboration later in this particular lecture. Fixed costs do not change with the units of production in the short run. So a fixed cost would be depreciation, factory rent, property taxes, supervision, things of that nature. let's talk about the term short run. For sake of our work in this course, we consider the short run to be the current operating cycle, which would be the current year, 12-month period. Variable costs change with the units of production. If you don't produce any product or deliver any service, you do not have any variable cost. Direct material and direct labor are very good examples of variable cost. If you don't make a product, you don't have direct labor. If you don't make a product, you don't have direct material. This is a graphic representation of how costs behave. Units of production are on the vertical axis. Dollars of cost are on the horizontal axis. You'll notice that the fixed costs do not change with the units of production. They remain the same. As we look at the sloped line where it intercepts the vertical axis, we have no variable cost. But as we increase our units of production, then the variable costs increase, commensurate with the number of units we produce. For a moment, let's talk about the impact that fixed costs have on our total cost per unit. Remember, we do not increase our fixed costs in the short run as we increase our units of production. At some point, we will increase our fixed cost, but for now, let's assume they're constant over a certain range. Assume our monthly fixed costs are $1,000. The variable cost per unit is $10. If we make one unit, we must assign all the fixed costs to that unit. So the total cost per unit is $10.10. If we make 10 units, the variable cost per unit is $10, and we must assign $100 of fixed cost to each unit. If we make 100 units, the variable cost is $10, and we must assign $10 of fixed cost to it. So the total cost is $20. Now, let me ask you a question. If we produced 1,000 units, what would be the total cost per unit? You probably guessed it. The variable cost of $10 plus $1 fixed cost, or $11. This phenomenon will continue until such a time as we have to add additional fixed costs. And that day will come as we add more equipment, more factory space, more supervision, and we expand. We will have to increase our fixed cost. And then this phenomenon, as I say, will reverse itself. We say fixed costs are fixed over a relative range. That relative range is the period in which the fixed costs do not change. At the end of that relative range, we have to add fixed costs. And normally they jump in big chunks. Another term you'll find we'll be using in this course is the term opportunity cost. Opportunity cost is an economics term, and it's an oxymoron. An opportunity cost is a benefit forgone by choosing one course over another. So we have two courses that we can take, either A or B, and both of them are profitable. If we choose to follow course A, then we forego the profit we make on course B. So that is the opportunity cost. It's what we're giving up. Now let's talk about how we calculate break-evens. This is a graphic representation of a break-even. You'll notice that we have our fixed cost line, our total cost line, which includes both the variable and the fixed cost, and a total revenue line. In the center of the graph, the total revenue line and the total cost line intersect. At the point that they intersect, We call that the break-even. At that point, we're neither making a profit nor suffering a loss. In the triangle below that intersection, we are in a loss position. In the triangle above that intersection, we're in a profitable position. And those lines will go farther and farther apart until we reach a point at which we have to increase our fixed cost. And then they will become narrower. So to calculate break-evens, we use financial information. In this example, we have the sales price per unit, we have the variable cost per unit, and the difference between the sales price and the variable cost is called the contribution margin. We'll be using that term over and over and over in this course. It's quite an appropriate term because those dollars, 60 cents, contributes to covering fixed cost, paying income taxes, and providing a profit. So we use the contribution margin in dollars to calculate the break-even in units. We also have to the right another column called ratio. This is the contribution margin ratio, and we calculate this by dividing the variable cost by the sales price. So 140 divided by $2 is 70%. 60 cents divided by $2 is 30 cents, 30%. We can use the contribution margin to calculate the break-even in sales dollars. Now let's calculate a break-even. Break-even is fixed costs divided by contribution margin per unit. Assume our fixed costs are $120,000. Our contribution margin per unit was 60 cents. Divide that out, and so the break-even is 200 units. So at 200 units, we are not making profit, nor are we suffering a loss. Now let's calculate the break-even in sales dollars. Quite often, we will not have the break-even per figures or the contribution margin per unit. So we can calculate the break-even by using the ratio. So divide 120,000 by 30%, you get $400,000. Now, if we have the sales price available and we have the break-even in units as we calculated on slide number 17, you can multiply 200,000 by $2 and you'll also come up with the 400,000. So you can arrive at sales dollar break-even in two different ways. Quite often, business people will do sensitivity analysis on their fixed and variable cost in trying to lower the break-even point. They'll trade off a fixed cost for a variable cost. For example, if you're in the trucking business, you can buy your liability insurance on a monthly premium, or you can buy it per mile. If it's a monthly premium, it's a fixed cost. You have to pay that regardless of how many miles you travel. If you buy it by the mile, you have converted it to a variable cost. If you don't travel any miles, you don't pay any liability insurance. Again, the whole purpose of this is trying to lower the break-even point. The sooner you break even, the sooner you'll make a profit. Now let's take into consideration targeted profit and income taxes. We not only want to break even, but we want to make a profit, and when we talk about making a profit, then we're incurring a tax liability. So the formula for break even at this point looks very much like the basic break even formula. The numerator is the fixed cost, plus we have added targeted profit divided by 1 minus the tax rate. And the fixed cost plus the targeted profit before taxes are then divided by the contribution margin per unit. Let's look at an example. We're going to go back again and assume our fixed costs are $120,000. We have a targeted profit of $30,000 and our tax rate is 40%. So, in the numerator, we have $120,000 plus $30,000, which is our after-tax profit, divided by 1 minus 0.40, which is the tax rate. So solving for the numerator, we have 120,000 plus 50,000 divided by 0.60. So in order to break even, provide a profit of 30,000 and pay our taxes, we now would have to sell 283,333 units. This is a graphic representation of a break-even in terms of diseconomy of scale. And I'm sure you think I've had 3 martinis before I drew this graph. However, quite frankly, this is a much better representation of how costs and revenues probably act, rather than using the straight linear representations that economists favor so much. Look at this closely. There are 2 intersections. Below the first intersection, we are in a loss. Below the second intersection, we are in a profit. And within that pocket, you'll notice there's a point in there which we actually are very profitable. Then all of a sudden, our revenues are less than our costs, and so we're now back into a loss. This happens because we add fixed costs in big chunks. And as businesses expand, they add fixed costs as a part of their growth. If you're not careful, you can reach this second break-even point and go into a loss from which you can never recover. Professor George Stigler at the University of Chicago Business School did a great deal of studies in the area of diseconomies of scale, in particular industries, aluminum, automobiles, and so forth. And he found that there were certain sizes in which a business was profitable, and they had to jump and take on fixed costs in big bites, and then make sure their revenue came in to cover those costs. If they didn't, they would go broke. And he referred to this as the survivor syndrome. It's very real. It happens to all businesses. And as businesses expand, they certainly need to be aware of what can happen as they grow. Now let's stop and do exercises 1-1 and 1-2. And you can either then access the solutions to these 2 exercises to see how you did, or you can wait until the end of the lecture and compare your answers for all the exercises. Now, up until now, we've been talking about break-evens where we have a single product. For example, air miles, freight miles, things of that nature. But quite often we have businesses that have multiple types of products or services. And we also want to calculate the break-even across the board. We call this a sales mix problem. And there are certain steps we go through to solve this type of problem. First, we determine the number of units that we project to sell. Then we calculate the contribution margin for each product by subtracting the variable costs from the sales price per unit. Then we calculate the weighted contribution margin. From that we can calculate the break-even in units and then allocate the break-even to determine what the break-even is for each product. And this is the formula for calculating weighted contribution margin. UCM is the unit contribution margin times the projected number of units for that product, plus the unit contribution margin plus the projected units for the next product, and the next product, and the next product, divided by the total projected units. From our example, the handout I gave you, our calculation would look like this. We projected 20,000 units, 100,000 units, and 80,000 units. We also have the contribution margin for each unit. So 3 times 20,000 plus 2 times 100,000 plus 1 times 80,000 divided by 200,000, you come up with 340,000 divided by the total units, or $1.70. That is the weighted contribution margin. Once you make this calculation, you should look at its reasonableness. It should be higher than the lowest contribution margin per unit and lower than the highest, and it should pretty much rest where the majority of your contribution margin per units reside. And that would be in the area of something slightly less than $2. So the 170 is very reasonable. Now we said we had a projected fixed cost of $255,000. So we want to get the total break-even in units. So we divide the total projected fixed cost by the weighted contribution margin, and we get 150,000 units. Now let's go back and calculate what the break-even is for each product. So there are 3 different types of products. We put 150,000 at the top of each one of the columns. Then we multiply that by the projected sales in units. So we said 10% of our meals were going to be early risers, 50% ham and eggs, 40% a child's meal, or a total of 100%. So we multiply 150,000 units by 10%, we get 15,000 units. 50% of 150,000, 75,000 units, and so forth. And you add those across, there's the 150,000 units for break-even. And now we can prove that by multiplying the projected units to break even by the contribution margin. And there's the $255,000. That's the amount that we need to cover our fixed cost. You can also arrive at the break even in sales dollars. For example, you have the contribution margin ratio of 0.4286. Divide that into 45,000, and so your break-even in sales for early riser would be $105,017. Now go to demo exercise 1-3 and see if you can solve that problem. The next thing we're going to talk about is operating ratios. And again, we're going to be viewing fixed and variable costs and contribution margins. Operating ratios measure firms' appetite for risk. We calculate the operating ratio by dividing the contribution margin in total dollars by the operating income in total dollars. This results in a ratio, an absolute number. The higher the ratio, the more risk the firm has. This means it is more levered. You can relate this to a teeter-totter. If a firm is more levered, when its sales increase, its operating income will rise more rapidly. The same thing happens if sales drop. Their operating income will drop more rapidly. The less levered firm, their sales increase, but their operating profit increases at a slower rate, and vice versa. Here an example of two firms. They have absolutely the same dollar amount of sales. They have the same operating income, which means their total costs are $950,000. But you'll notice that Alpha's variable costs are $500,000 and Beta's are $200,000. Alpha's fixed costs are $450,000. Beta's are $750,000. If you divide the contribution margin of $500,000 by $50,000, you get a ratio of 10. If you divide $800,000 by $50,000, you get a ratio of 16. So we say Beta is more levered. The higher the fixed costs are as a percentage of total costs, the more levered the firm will be. But if you remember from the teeter-totter, the greater leverage allows you to increase your operating profit faster when sales go up, because you're spreading your fixed costs over more units. Where if you're less levered, you're still dragging variable costs in to your additional units. So let's assume that the sales increase by 10% in each firm. So to get the change in operating income, you multiply the 10% increase by the ratio. So in the case of Alpha, it's 10% times 10, or 100%. So the new operating income would be $100,000. In Beta, it is 10% times 16, or $160,000. So its operating income would be $130,000. Now, if sales dropped by 10%, Alpha's operating income would be 0. But Beta would be in an operating loss. You cannot take the published financial statements of two companies, even in the same industry, and make this calculation, because you do not know the mix of their fixed and variable costs. This is proprietary, confidential information. Now, quite often, firms will belong to an industry trade group. They will submit their financial information to the trade group, which will then be sanitized, and they will distribute information that allows firms to make a similar calculation to the one we have above, based on geographics, etc. This is a real phenomenon, just like the diseconomy of scale. Now, there will be a time out there where Beta will have to add more fixed costs, and Alpha will have to add more fixed cost. And when that happens, it's going to change the mix of the fixed and variable cost and change the operating ratio. As a firm matures, they have a tendency to add fixed costs as a greater percentage of their total costs. They do this because they know they can spread the fixed costs over more units and drop the average total cost per unit, as we saw in an earlier slide. This could be both good and bad. Let's talk about the automobile industry in the United States between 2007 and 2010. General Motors, Chrysler, and Ford are very mature companies. They had huge fixed costs in terms of bricks and mortar, pension fund liabilities, things of that nature. As they could increase their market share and sell more automobiles, they could spread these costs over more units, and thus their average cost per unit dropped. But when the reversal occurred and their market shares shrank, then they were spreading these costs over fewer units, and so their cost per unit increased drastically, ultimately pushing Chrysler and GM into bankruptcy. So this is somewhat related to the concept of economy of scale. Again, something to be very much aware of as a business person. Now let's do exercise 1-4. Now we're going to talk about mixed cost and cost estimations. A mixed cost is a cost that has both a fixed and variable component to it. It should not surprise you that about 80% of our manufacturing overhead and our SG&A expenses are of a mixed nature. Estimating mixed cost is very important in the budgeting process. You need to be very accurate in your projections. Let me give you an example of a mixed cost before we move on. Electricity is a good example. Let's assume that you live in an all-electric residence. It comes the Christmas holidays and you go on a vacation. You pack up, and as you leave the house, you turn the thermostat down to a level that the pipes do not freeze, but so low that you would be uncomfortable if you were to live in the house. That level is the fixed cost level of your electricity. You come back from your vacation. You turn up the thermostat. You empty your suitcase. You wash your clothes. You start using electricity. The water heater heats up. If you were to go outside and look at the meter while you were gone, the meter would be moving very slowly and it would be measuring the fixed cost. If we go out after you return, the meter would be going very fast. That now is your total cost, which is both the fixed and variable component. If you ask your electric power company to come out and tell you the difference between the fixed portion and the total portion, they could tell you the variable cost usage. And so that occupancy is driving that cost. When the residence is unoccupied, you don't use as much electricity. Now we can mathematically calculate and separate the fixed and variable cost based on some historical information. Now caveat, if you're making a projection based on historical information, you have to be careful that the information you're using is predictive of the future. And we're going to use an Excel program to do that. And I've given you a link to access that particular program and download it if you've already not done so in a previous class. We are looking at a resort hotel. We have days of occupancy and cleaning supplies. And you'll notice as the occupancy increased, we use more cleaning supplies. Cleaning supplies is a mixed cost. If we have no one residing in the hotel, we still have to clean it. So you still have cleaning supplies. That's the fixed portion. As we increase the days of occupancy, you increase the cleaning supplies because we have more rooms to clean. We have some terms for days of occupancy and the supplies cost. Days of occupancy is referred to as a cost driver. It is what drives the supplies cost. It is known as the independent variable. Supplies cost is the dependent variable. The changes in the days of occupancy, the independent variable, cause the changes in the dependent variable, the supplies cost. So now let's take this information and using the Excel regression program, see if we can separate the fixed and variable components of these costs so that we could make a projection of what the cost might be at some future level of days of occupancy. And this is what the printout would look like. There are 4 significant numbers up here. The multiple R, which is known as the coefficient of correlation. It tells me the degree of relationship between the independent variable and the dependent variable. A positive 1.0 is a perfect relationship. A negative 1.0 is no relationship. The R squared is a coefficient of determination. It tells me what percentage of the time a change in the independent variable results in a change in the dependent variable. Since one number is a function of the other, these move very closely together. From my experience in making projections of this type, I want to have a multiple R of at least 0.80 and an R square of at least 0.60. If I don't have this relationship, I will then look for another independent variable that is a better predictor. I will look for something other than days of occupancy that may be driving the cleaning supplies cost. You will find different opinions on what those ratios should be. Mine comes from my experience of doing literally thousands of these over a number of years. Now let's go clear to the bottom of this slide. You see intercept and days. The intercept represents the fixed cost based on the average of the numbers we're using. So on the average each month we use $3,973 of fixed cleaning supplies. Days represents the variable portion. So for every day of occupancy, we incurred an additional 77+ cents of variable cost. So now if we wanted to make a projection of what our cleaning supplies would be at 10,000 days, we would take $39.73 plus 77 cents times 10,000 days, add them together, and that would give us our total projected cleaning supplies for that future period. This is an extremely useful technique and tool to use and very important in your budgeting process. So now go ahead and do demo exercises 1-5, and this completes the lecture material for module number 1.